Wednesday afternoon. Right now it's 1 o'clock. As scheduled, we're going to have this session on listed property. And as you know, that we're currently going through the worst period in terms of load shedding. It's now yesterday announced as stage 6. I hope you find your ways of coping with load shedding, whether you have emergency light, whether you have a generator, or whether you have solar, etc. But yeah, the situation is looks rather dire. But hopefully that the industrial action can be resolved quickly, and that we can be back to normal, so to speak. Yeah, so that's the situation right now in South Africa. But I just like to welcome all the viewers wherever you are in South Africa on the various platforms and wherever you are in the world. Thank you for joining us live. And today we're quite glad to have Kundayi Munzara from Sesfikile Capital to talk to us about the listed property sector in South Africa. And I think that in South Africa, or at least what I picked up from the people I spoke with, that South Africans have love for property. People, they love to buy property for their own residential, buy to let. They're looking at deals, and if they have a piece of land, they're looking to build a house, flats, etc. Looking to do business or generate income. So there's a love for property. And listed property is part of that, the big picture. And I think that without further ado, let me introduce to you Kundayi Munzara from Sesfikile Capital. He's Executive Director and Portfolio Manager. Kundayi, how are you doing?
I'm all right, Kevin. How are you?
Fine, thanks. Today's been cold, but I'm glad that you join us. And you look well and look strong. Yes. So with that introduction, I just like you to maybe tell us about Sesfikile. Who is Sesfikile Capital? How does it all start? And tell the viewers about what you do and your company does.
I'm happy to. Well, thanks a lot, Kevin, and happy to share our journey a little bit. So, Sesfikile Capital really is an asset manager, but I think a key distinction between us and maybe some of the other big name asset managers that many of the viewers would know about is that we are a single sector asset manager. So we manage money on behalf of clients. The bulk of our clients are South African pension funds, but we also have financial advisors and multi-managers and individual investors as our investors. And we invest their money and invest that solely into the listed property sector. In terms of our business, and maybe if you show it on the next slide, Kevin, is that our business was formed back in 2010. And this was founded by three people, two of my colleagues, Muhammad Kalla and Evan Jankelovitz, and me. We literally just got together, from the sector. I was at Investec, Evan was at Stand-up, Muhammad was at a company called BJM Securities. And we got together to simply set up a focused listed property asset manager. So that's what we do. That's what we've been doing for almost 12 years now.
All right. Thanks for that introduction. Just remind me, BJM Securities, I know them before, but where are they now?
So BJM Securities ended up being bought out by RenCap. So I think there was a company called Renaissance Capital, which I think interestingly had links to Russia at the time. I think it was a Russian investment bank, came into South Africa to set up and then was buying up a few stockbrokers, and they bought BJM Securities at that time.
Right. So the name of BJM Securities, does it still exist or the name changed?
No, the name is, I don't think it exists. I think one part of the business was sold to RentCap, and then another part was sold to FNB, private clients. So you
All right.
probably won't see it appear anywhere. I mean, but for I think a lot of us in the industry, we've been around for a while. BJM was quite an important name in terms of stockbroking.
Yes.
Recent,
Yeah, I think it's Barnard Jacobs Mallet.
That's it. That's it. That's
Yeah.
it. 100%. Yeah.
Yeah. Okay. So from what I see here is that Sesfikile is a very focused just on the property sector, listed property, and that's your single focus, and which is great because sometimes like some managers they try they have their different skill sets, and your skill set you know what you're good at, and you focus on a specific sector. And
Yeah.
congratulations! I saw this on this one. You are winner of certain award, Citywire. Can you tell us about that?
Yeah, I mean, we liked the story. So obviously over the last almost 12 years now, we now manage about 17 billion for clients. But I think the important thing for clients has really been the level of performance that the clients have received from both our
Yeah.
strategies, both the local and the global. And I think part of that maybe culminated in some respects to us winning the Citywire Best Fund Group for 2021. And obviously we're always appreciative of our clients for allocating funds to us, trusting us with the money. But sometimes it's actually quite nice to get kind of that validation as well. So Citywire is, I think, an important award in that they look not only at South Africa, but they look, all over the world. And I think it's good to get that sort of recognition from time to time. So quite happy with that as well from our perspective.
No, that's great. Yeah.
Yeah.
And then let's talk about the people in your company.
Yeah. So
I
so
see
happy
your
to do
picture
so.
there.
Yeah, we keep adding. You'll notice on the slide that there's one without a picture, which looks like an egg, but that's just
Yeah.
a new person who's joined the team. So
Yeah.
in the team, we're a total of 10
Mm.
across both the investment side and the operation side of the business.
Yeah.
So as I just said a slide ago, the three founders is Mohammed, Evan, and me.
Yeah.
We brought on over the years, we brought on Anil Ramji, who's now a portfolio manager focusing on our global fund. We've
Yeah.
got Naeem Tilly, a very highly rated individual in terms of when he was at AVO in the south side, but also he spent a little bit of time at Catalyst before joining Sesfikile Capital, and he joined about 4 years ago as a portfolio manager, and he's our head of research. And then
Yeah.
we've got a five-person operations team, and that operations side is really headed by Tinswalo Hlebela in our business, who heads up investment ops. The person who doesn't have a photo is Minentle Yoba, who just joined the business on the 1st of June. So we haven't quite got around to doing the photos yet, but very soon we will. But we're quite
I see.
happy that we're quite a
Yeah.
strong, I think, experienced team in the sector, both in the investment side and also in the operation side.
Okay. No, that's good in terms of the depth and the width of your team.
Yeah.
Okay. Then in terms of your product offering.
Yeah, happy to introduce this. So as you said, Kevin, earlier, we're quite focused and we've remained very focused over the years. It's not to say that we've never looked at other opportunities outside of these two products, but I think the philosophy of the organization has generally been play in areas where you can win or play in areas where you can add real value to your clients. And for now, we think that these are the areas that we can add value. Over time, there's nothing stopping us from adding new strategies. But I think at this point, our real focus is the Sesfikile, I'll call it the SA strategy, SA listed property strategy. And what
Right.
that is investing in South African listed property companies that are on the JSE on behalf
Yeah.
of clients. And then the second strategy, which is also very exciting, is the global listed property strategy. And that is investing in offshore listed companies in developed markets, specifically North America, Europe, including UK, and developed Asia as well.
Yeah.
So the way I think we look at it, and some of our clients look at it, is that if you want the emerging market exposure, you get it via the SA strategy, which also has a little bit of exposure to Eastern Europe, and I'll talk to this later. But if you want to diversify from the emerging markets, but still like the property exposure, you get the global property exposure, which is offshore developed real estate markets. And that's really what our focus is in the business.
Right. Now I'm putting you on the spotlight. So how many listed property companies are there listed on JSE?
Oof, okay. It's not much of a spotlight. It's okay. So we've got 36 investable opportunities.
Okay.
So if I was to answer your question more strictly, I would say I think the number is 41, which is the number of listed property companies that you can invest in. But we've got 36 that we would say are investable. And what I mean by that is that there are a few that are listed but are very small and are very tightly held. So even if you wanted to buy those shares, practically it's quite difficult. And that's the opportunity set that we look at, and maybe your investors, your viewers can also look at as well.
Right. And I also note on this slide that you have listed public companies / REITs. So can you explain to us that what's the difference? Are all the listed public companies REITs, or are they not? And which companies qualify as REITs?
Yeah, so it's an important distinction, an important question as well. So the short answer is that not all of the 36 investable listed property companies qualify as real estate investment trusts, which are REITs. In terms of how the companies behave, meaning do they pay distributions or dividends to shareholders? Do they hold property assets? Do they have limitations on their balance sheets in terms of gearing or loan to value ratios? Yes. So when you look at the companies, a lot of them actually look the same. But strictly speaking, only a portion of the companies, it's the majority of it, but not every one of those companies are REITs, strictly speaking. And the key distinction is that if you're a REIT, if you make an application to the JSE to become a real estate investment trust, there are certain limitations that you need to tick, or boxes you need to tick. So you certainly must have a minimum of 300 million in assets, but a lot of these companies are way beyond that. You must be listed. Obviously, we're only talking about listed property companies. Importantly, 75% of your distributable income, we'll call it your operating profit, must be paid in the form of dividends or distributions. So I think the key distinction is that some of the companies that are not REITs have the option of paying less than 75% of their income as distributions or dividends to shareholders. But a lot of the look and feel of the company is really like REITs. So an example is Nepi Rockcastle, which is not a REIT, strictly speaking, but in all respects behaves like a REIT.
I see.
Yeah.
And Kundayi, is it preferable, or it's better for investors to invest in REITs, or you don't? What's is that? Or are they just the same?
I think, broadly speaking, I think investors tend to get a little bit more comfort by investing in REITs. So I would say investors that are sensitive to income, or investors that are investing in property because they like the income aspects and they like the capital appreciation, so they want the combination, find a little bit more comfort investing in a REIT. And the
I see.
reason I say that is that reason that I gave before, to say, if you're a REIT, not only do you have uh, the issue of the minimum income you must pay,
Yeah.
but also there are limitations on your indebtedness or your loan to value of
I see.
60%. So you can't have 60% you can't have debt being more than 60% of your total assets. If you're not a REIT, some of those limitations do fall away, particularly on the
Okay.
payable income side. So
Okay.
it is a little bit maybe safer, so to speak, if you're an income sensitive investor.
Okay. Thank you for your explanation. Then let's talk about your investment process and performance. So how have you done for investors over the last 10, 12 years?
Well, on performance, I'll answer that in 2 slides' time. But on
Yeah.
process, so here I'm really strictly speaking about our South African strategy, or our SA
Okay.
listed property strategy. And what we have here and what we call our process is the 4D approach. So it does have a cool ring to it, really, and especially when we're talking about 3D at the time we're setting this stuff up. But
Yeah.
the 4D approach really looks at property through various aspects. So the first one is really looking at the actual asset, which is the direct property D. And that's making sure that, as part of our investment process at Sesfikile Capital, we spend a lot of time actually visiting the underlying assets that we invest in, or that these
Yeah.
companies. So a lot of our time is spent visiting shopping centers, industrial warehouses, office
Yeah.
blocks all across the country and also globally. At this point, one of my colleagues, Evan, is actually in Spain looking at Vukile's property portfolio to make sure that
Yeah.
at every time we are well
Yeah.
versed and really understand the locations
Yeah.
of the assets. The
Right.
detail, which is the second D, is basically looking at the companies more through a financial analysis lens and making sure that we model every one of the companies that we invest in. So we shouldn't only rely on what management guides or what the market consensus is, but we must model these companies ourselves to get a fair assessment of what we think the earnings power of those companies is, and also what the risks are, either at asset level or at balance sheet level. So we are very detailed in the process. But even if you go see all the properties and you're detailed in your modeling, you must understand the third D, which is the drivers. So
Okay.
the third D is really talking to say that every company, and also when you're looking at the listed property sector, one mustn't lose sight of the key drivers of returns or the key drivers of outperformance. So, Kevin, if I was to give you an example of a driver at company level could be a particular development that the company is doing, and what that will do to the balance sheet, what that will do to the earnings. It could be a particular acquisition. In addition to that, when we look at it from a, let's say, macroeconomic perspective, at this point, there are many investors that are concerned about inflation, interest rates,
Yeah.
and what central banks are going to do. And I
Yes.
think it's important to say that you mustn't lose sight of those things as particular drivers for what your listed property companies will do. And I think it's affecting all markets at this point. So the last D, which is maybe particular or peculiar to the listed property sector, is the deals. So you'll find that because of these companies needing to pay out a big portion of their profits as dividends or distributions, any expansion activity typically results in capital raising. And because of that, there are many times when there's opportunities that the companies capital raise by issuing stock, and we can buy that stock at a significant discount to market. And those are some of the things that add a little bit more alpha or outperformance relative to the benchmark to the portfolios over time. So when we're looking through the companies and we're looking through our portfolios, we're always looking at it through the lens of these 4 Ds in our process. And I think if you were to go to the next slide, just to touch on something that is gaining much more prominence, and I'll speak a little bit to it, is the issue of ESG, which is environmental, social, and governance. And I think importantly, at Sesfikile Capital, we've always had a big focus on the G in ESG, which is the governance factor, making sure these companies have got strong boards, independent people on those boards, management teams that are doing right and are aligned to the shareholders as opposed to aligned somewhere else. But the social and environmental aspects obviously are becoming even more prominent. So for many of the viewers, it's almost a year now when we had the riots, particularly in KZN and Gauteng. And I think that was a reminder that as property companies, if you are not investing in the communities as well, that you have these big shopping centers or different types of assets, sometimes you could put yourself at a massive risk because you're not ticking the S box in terms of doing enough from the social perspective. And then on the environmental side, in terms of funding, there's much more better and cheaper funding for what's so-called green bonds or green funding, which is making sure that when you build these portfolios, they are environmentally sustainable, either from a lighting perspective or water perspective, to make sure that they're doing minimal harm to the environment. So as we look at these companies through the lens of the 4Ds, we certainly cannot ignore the ESG as part of our process. Yeah.
From those two slides, I can certainly say that you have a very solid process. Over the years, you have developed those processes and improve on those processes, and you know exactly what you do and the things that you're looking for when you are looking at these, evaluating these investment opportunities. Kundayi, I just want to go back to the previous slide, and I just want to ask you, because the first D is the direct, but you don't invest in a property directly, right? So you only invest in these listed property company who invest in those properties. You go and check, essentially do the due diligence, but you don't hold a property directly. Is that right?
That's 100%, Kevin. So we hold shares in companies that own commercial property, and we don't have the ownership to the asset directly. We just have the share in the company that owns the asset.
Yeah. And then the third one about drivers, you talked about the macroeconomic and that, and I think that the big picture that's taken place last 2 years is certainly COVID. No one expected this coming in such a big way, and how it has affected all of us, and it certainly has impacted the property sector big time. So is that something you also monitor and continue to evaluate, and then arrive at your decisions in terms of how your investment is going to look like?
Well, absolutely. I mean, there's absolutely no choice. There's no way anyone could have avoided monitoring the impact of COVID on the underlying tenants and effectively the underlying assets. So I think what is worth saying is that the South African listed property sector, certainly from a retail perspective, if we're talking particularly the convenience or community retail centers, those centers fared quite well. So when I'm talking about community centers or convenience centers, I'm talking about the open air centers. They typically will have a Pick and Pay or a Spar or a Checkers as an anchor. It will have a hairdresser. It will have a KFC drive-through, maybe a McDonald's. Those sectors have done really well in being quite defensive. The office sector obviously has been severely affected because, unlike me, there are many people working from home at this point. And because of that, there's just kind of less people coming to the office. And because the economy was quite weak, the vacancies went up in the office sector. Interestingly, in the industrial sector, we've actually seen that sector witness even stronger demand. So what happened with COVID is that a lot of us were forced to go online and do more of our shopping online. And that has created a little bit more demand for the industrial sector, as more goods need to be stored in warehouses to be delivered directly to the consumer. So it hasn't been an all fall down or all bad scenario. It's been mixed. Where offices suffered, big shopping malls have suffered. Convenience centers have done well, industrial has done well as well. But we have to continue monitoring the health of the underlying tenants as part of the job in understanding the direct part and also the drivers of some of these returns.
And I just want to ask you about load shedding, because, unfortunately in South Africa, with the perennial ongoing problems with electricity supply, Eskom and that, and the load shedding, it looks like it's going to be with us for foreseeable future. And how is that impacting the shopping centers, the big and small? Do shopping centers now do they invest in like solar energy or generators in order to provide a better service to the tenants, or the operational ability for the tenants, or the shopping centers just say to the tenants, everyone is for themselves. You need to just make things happen for yourself.
Yeah, thanks. That's a good question. I think what has happened is, load shedding probably started, I would say maybe 8 to 9 years ago in South Africa. So I think a lot of people, unfortunately, there were a lot of people that were in denial about it and thought that it was going to be 1 to 2 years. And unfortunately, it's gone very long. But fortunately, the South African listed property sector has not been in denial and has made a lot of significant investments in matters around backup power. So it started off with generators, but then generators proved to be, I would say, probably environmentally less friendly or unfriendly, because a lot of them are diesel powered. And also from a cost perspective, they're quite expensive to run, especially now. What the sector did is that the sector invested quite heavily in solar. And you'll notice that there's so many shopping centers and big industrial warehouses that have solar panels at the top. So you'll find that there's many shopping centers, across, and I think a lot of the viewers would know that, sometimes if you have a park at your home, maybe there's a bit of an oasis at the shopping center where you've got power still as backup. And it's proven to actually be a good investment for these companies, because as electricity prices have continued to go up, they're starting to see that they're actually getting operational benefits, efficiencies from investing in the solar. So that has gone quite well.
Okay. No, I can attest to that. In my nearby shopping center, Douglasdale, that when there's load shedding, then people flock to Vida E Cafe because they still have Wi-Fi. So
yeah, exactly. Do they go to Pine Slope Shopping Center maybe?
Yeah, that's also another option,
yeah, exactly.
Yeah.
Exactly.
Okay. So then, Kundayi, let's move on to performance. So can you unpack this for us?
Yeah. So we're happy. This is an interesting slide for us, because we're happy in some respects, but not so happy in others. So what I mean by it is that on an absolute basis, the listed property sector has delivered okay returns for investors, and not that attractive really because of the last few years. If you look at 2018, 2019, and 2020, which was the big drawdown or negative year because of COVID, the listed property sector has only kind of just kept up with inflation from a total return perspective, if we look at the numbers since inception. Last year was a very strong year where the sector did just under 40%. So that was a good recovery year for the sector. But I think for us at Sesfikile Capital, our job certainly the job that our clients have mandated us is that your job is to outperform the index. We give you money so that with the target of outperforming the index over time, and we view it as over 3 to 5 years and beyond. And we're happy to say that across both our SA listed property strategy and our global listed property strategy, we've been able to outperform our requisite benchmark. So if we're talking about the SA strategy, which is obviously the focus today, since inception, we've managed to outperform the benchmark by about 3.7% per annum. And it's important to say on an after fee basis. So, we're not going to change the number when we start putting fees in. It's actually on an after fee basis.
Okay.
So generally, I think we're happy to say that the clients who've made the allocation to us within the sector have done better than the benchmark, certainly over the period. And I think we've continued to outperform over 1, 3, and 5 years. If you look at our global listed property strategy, which again, I said invests in offshore developed markets, North America, Europe, Asia Pacific, developed Asia, that has also outperformed the benchmark since inception. And if you look at the 3 and 5 year numbers again, which we really focus on, we've managed to outperform those benchmark by between 2 and 3% on an after fee and after all basis. So I think in terms of the processes and the team and the experience of the team, I think using history, we've demonstrated that we've been able to outperform the benchmark, and hopefully we'll be able to do the same on a going forward basis.
Kundayi, I think that if I look at these performance figures, I would say is that your SA listed property has really done well for investors, and kudos to you and your team, because like 1 or 2 years could be fluke, but on a long-term basis, 10 years and since inception, to be able to generate this kind of outperformance, which we call alpha, this is really exceptional. It's in my line as an actuarial or statistical speak, we will say it's statistically significant. It's not, if you're over the long term, if you just have an outperform of 0.2, 0.5%, maybe you say, it's it can change in any year, but to be able to realize this result for investors over the long term, I think this is a job well done. Then in terms of your global listed property, I think this is for me. I would say that I will continue to monitor and evaluate how you guys do. Certainly, it's for your team is a new space, even though you have been there for 5 years or even longer. But I for me, from the outsider looking in, I thought, for you to go onto the global stage and to compete against everyone, and they are REITs or like property managers in the US, Europe, and all that. And for you to compete in that space, sure, I would say it's pretty tough. It's pretty competitive space.
Yeah, I mean it's tough everywhere, Kevin. It's tough here, but obviously this is a market that we've been in for very long, because we were doing South African listed property even before starting Sesfikile Capital. But in the global space, similarly, Evan and I used to manage money in our previous jobs in the global space. And when we decided to launch this in our current outfit in Sesfikile Capital, we were comfortable that we had the requisite experience. And I think if you look at some of the global rankings, I would encourage some of the viewers to look through maybe some of the Citywire rankings of maybe up to about 300 managers. We're a top quartile manager over 3 and 5 years. Have ranked between maybe 11 and 30th or out of 300 plus managers. So yes, it's a competitive space, but I think the big question, and this has been spoken about lately, can South African managers manage money offshore? It's a big question, but I think we've demonstrated, and many managers have demonstrated in South Africa, that You don't necessarily have to sit in London, New York, or Singapore to manage money globally. You can do it with the same info as long as you've got a clear process. You can actually manage this money from a different location, but you do need to travel to these different locations, which we do.
Yeah. Okay. I think this global listed property is a topic for another day. Okay.
Yeah.
So let's let's move on to So you have here as a market overview. Would you like to take us through this the overview of the listed property sector?
Yeah, so I'm quite happy to do this and give a bit of a sense of where things are at this point. But just before I do that, the starting point is looking at the listed property sector in context. So the listed property sector, as I said before, about 36 investable opportunities with listed property companies. The total market cap of the sector is about 360 billion. In context, that's about 2% of the total JSE. So it's quite a small portion or small sliver of the total market. But what is interesting and attractive about listed property, maybe a key question people ask is this stuff even investable, as the topic said? But listed property is an attractive asset class for investors who are looking for income and growing income. And the sector currently offers a dividend yield of about 9.5%. It's actually closer to about 10% right now. And then those income streams have been growing, or we expect them to grow at about 5 to 6%, which is just around inflation at this point. And we think that they could grow beyond that in a few years' time. What is great about the sector is that the balance sheets, the loan to value ratio, this is basically your debt over your asset value, is about 38%. So it's not too much debt in the listed property sector. And a big important thing is that 77% of those balance sheets or the interest rates on those balance sheets is hedged against rising interest rates. So right now we know that the SARB is hiking rates at this point. So is the Fed in the US, but 77% of that debt will be unaffected because it's hedged for the next few years. And if you look through the listed property sector, I think from a diversification perspective, I'm talking specifically the JSE listed property sector, is about 50% of the assets actually assets in South Africa. And then the balance is a combination of Central and Eastern Europe, particularly Romania and Poland. We've got a little bit of UK, a little bit of Australia, and a little bit of the US. So what happens is that some of these companies have large portfolios where they've got assets in South Africa and assets offshore. And also from a sector exposure perspective, I mean, many of my clients, when they see a lot of cranes in the office nodes, they say there's so much supply. Why is the listed property sector? How is the listed property sector doing when there's so much supply in the office space? But an important thing to know is that on a see-through basis, only about 17% of the total see-through exposure is offices. The bulk of that is actually retail shopping centers and convenience centers. In terms of the sector. So you get a good sense of diversification. You've got 36 companies. The balance sheets are in decent shape. You've got attractive income and growing income as well. And that's a good sense of the sector. But I'm quite happy to also take you through a bit of an overview of some of the companies that we hold, and also what we think of the market in general.
Kundayi, I think this is a beautiful slide because it summarizes what you do, your sector, very nicely. And when you say about a total market cap of 360 billion, and I think someone actually contrasts this with like a couple of the biggest funds in South Africa, like your Allan Gray Balance Fund. So this is just about like over twice the size of Allan Gray Balance Fund. So this is just to contrast the size. But if I look at this, the income yield certainly is very attractive. How secure is that? How stable is that? Because you can have, like this looks very attractive yield, but then you only need like a more load shedding and then maybe economic struggling, then maybe suddenly you are not seeing 9.5%. Maybe over the next 12 months, then listed property companies say that they're struggling to keep their tenants, or tenants aren't paying, and maybe all of a sudden you see that 9.5% drop to 7%. How secure is that for investors?
Well, it's fairly stable. So it's certainly not guaranteed
Mm,
on a forward-looking basis. And as
yeah,
we saw in 2020, sometimes there are major events that happen that are completely unforeseen. So
yeah,
the listed property sector suffered a lot of income loss, really,
mm,
because shopping centers
sure,
simply couldn't even open during level 5 lockdowns.
yeah,
And those yields certainly went lower because the company simply couldn't earn those rents. But
mm,
where we stand, we're quite comfortable that the balance sheets are in good shape. We're
mm,
comfortable that the asset values are fair and they're not
mm,
massive write-downs to come. We're also
mm,
comfortable that although the economy is in a tough space,
mm,
there's load shedding concerns,
yeah,
we're on a recovery path in the economy. So I think
right,
and I think it's fairly stable. And also
mm,
importantly, that 9.5% is your dividend or distribution yield. The
yeah,
companies do hold back a little bit of income, so there's
mm,
a bit of a buffer
yeah, yeah,
between what they can actually distribute and what they do distribute. And what I showed there is what we think they will distribute. So I think it's fairly
mm.
stable at this point.
All right. And Kunda, I'm aware of the practice in the past where some companies, in order to look good on the, on this yield, they actually distribute more than their earnings or profits.
Yeah.
So what's the practice at the moment? Do companies still do that, and then only to find themselves shortchanged in a year or two's time?
So that was so if you go back to let's say 2007 and 8,
Mm,
that was probably the most extreme portion when the companies were distributing capital profits. So they'll sell a building at a profit
yeah,
and distribute that.
right.
In some respects, there was deal fees or non-sustainable, non-recurring income that would be paid,
Mm,
and we found that that practice started to really shrink and started to grow again until about 2018.
yeah.
And when we had the big market drawdown, we found that the companies rebased a lot of their earnings, and a lot
Yeah.
of this is actually pure rental income,
Mm,
obviously after costs. And so a big portion of this 9.5 is a real sustainable number that the companies can distribute. So
mm,
we'll call it the fun and games of the past is very
mm,
much on the margin.
yeah.
But it's not a mainstream practice in the business sector.
Mm. Mm.
Yeah,
I think also from this slide about you mentioned that 77% of the debt is hedged against rising interest rates, which is a
yeah,
good thing, because that for people that's not aware of such loan agreements, they will think that with the rising interest rates, all these listed property companies, they will be paying more and more interest, and maybe they will become unstuck with a gearing and all that. But at least 70, a very high percentage of the debts are protected. So yeah, okay, that's good to know. Then
yeah,
in terms of if I look at the country regional exposure, and I think that certainly will be an eye opener for a lot of investors, as young investors out there, that like if you invest in a listed property, it's not just investing in South Africa, but rather here you also have your Central Eastern Europe. That's also the emerging market, and
mm,
then a bit of Western Europe, UK, the developed markets. So overall, then obviously with South Africa being part of the emerging market, the listed property sector on the JSE is probably very much like emerging markets feel to that.
yeah,
And so now with Central and Eastern Europe, I think that That's where a lot of investors will ask question, whether Ukraine war, the Russian invasion of Ukraine, and the war seems to be ongoing for a long time. It's like Russia is not looking to back down. It's going to continue with the so-called military action in Ukraine. And how has that had any impact on any of the listed property companies having investments or properties in that area?
Good question. So what you will notice, and I think we've got a slide which is further on, and maybe
Okay,
Kevin,
we can talk about it later.
No, we can talk about it right now. We can move
Okay.
there. Is that if you move to slide 17, what it will show you is that the South African listed property sector that slide, sorry, not 17, it's actually the slide before. So what you'll notice, it's a slide before that. It's probably slide.
Sorry. No.
Yeah,
I moved too fast.
Yeah,
Okay.
yeah, it moved a bit quickly. But what you'll see that the South African listed property sector is 26% exposed to CEE, but the bulk of that exposure is in two countries, specifically Poland and Romania. And there is zero exposure to Russia or Ukraine. But the other, exposures is Hungary, Bulgaria, Croatia, and Moldova. And there are other countries there. The important thing as well is that there's been actually very little to no impact on the companies or the assets in Poland and Romania. I was actually there during April to make this assessment myself. What we did notice is that the funding costs or the cost of debt in the region has gone up significantly. And I think that is more a factor of investors looking at the proximity to Russia and Ukraine and saying this area could be a little bit more risky than we initially anticipated, and they're putting a bit more of a margin. But from an operational perspective, these economies are currently at 3 to 4% unemployment, high consumption. We're seeing very little impact of the war at this point, but from a sentiment perspective, it's obviously quite negative.
I see. Okay.
Yeah.
This is also a very nice summary. Okay, so then let's just move back to that. Okay, so so in terms of the sector exposure, again, I think it's an eye-opener for investors that when you invest in listed property sector, then you also have a kind of a diversification in that sense, in terms of retail, office, and industrial, and even residential, and the storage. So it's not just one. I think that on the global side, and you have even some other investment opportunities like healthcare. Then you also have like data centers. So are these not something that's available in South Africa?
Not yet. So in the global space, I think we've got about 16 to 17 different sectors to choose from.
Sure. Okay.
And a high degree of specialization, but we're not yet there in South Africa. In South Africa, as I said, these 5 sectors, retail, office, industrial being the big ones, are the main exposures that you get. But we are slowly seeing, I think very soon there will be something around student accommodation. I think very soon we could see something in the data center space. But it's not yet, unfortunately, it's not yet here in the South African space. But there is good diversification.
Okay. No, that's this is good to know. Okay. Then Kundayi, I think that if you can just you mentioned about those different property companies. I see you have 5 listed property companies you put on the slide. Can you just go through, walk us through those ones and explain to us what are these companies? What do they do? What's the investment case?
Yeah. So just to make a note, I mean, in our portfolio, we would hold, about 20 to 24 stocks out of the 36 invested ones. But I thought to pick some of the key ones that we invested in the portfolio. So that is a specialized company. And what you see is that they invest their portfolio both in South Africa and the UK. What's great about the company is that they're offering a dividend yield of about 9%, very long lease profile. So their weighted average lease profile is 15 years. So it basically means that on average, their leases are 15 years long, which gives investors, quite a lot of security of income, especially in these difficult times, which, where we've got global market volatility. Importantly, their balance sheet is also well leveraged. By well leveraged, we mean that it's not over indebted at an LTV of about 31%, and it's a very strong management team. So we like the company. We like the industrial sector in general, especially modern logistics. It's got two key drivers. One is modernization of supply chains, and this other driver is growth in e-commerce. So we think long-term, this is a good story. Another stock that we like a lot is called Storage REIT. And a lot of, I think the viewers, when they drive around Joburg and Cape Town, and
they're very visible.
You see the red boxes that say storage. And that's the company that owns these assets. So what we like about the storage sector, what we like about the company is that it's specialized. Again, you'll notice that we particularly like companies that specialize. We ourselves buy into that as Sesfikile because we are specialized. And what you see, the storage sector, what's great about it is that it's a sector that is less reliant on the business cycle. In loose terms, globally, they call the key drivers for self-storage as the 4Ds. Some of them are morbid, but it's really death, divorce, destruction, and dislocation, which are the key drivers for self-storage. So as people grow older and typically they downsize their homes and need to store stuff, when people get divorced, unfortunately, they have to store stuff. When dislocation, in some respects, people tend to store stuff. And sometimes when there's disasters, people store stuff. And this stuff happens whether it's a bull market or a bear market. And we find that the occupancies in self-storage typically are quite stable, irrespective of the market cycle. And we like them for that. Newcastle is more about Central and Eastern Europe. They own retail parks and shopping centers across Central and Eastern Europe. As we said, Romania and Poland exposure. We think vacancies are very low. Unemployment is extremely low. Consumption is growing very fast in those economies, and GDP growth is very strong. So it's a play on Eastern European retail. Redefined property we see as a large cap value play at this point. Diversified with a big portfolio across South Africa in all sectors, but also they've got some retail in Poland and some warehouses in Poland as well. So we think they're quite attractive. And then lastly, we like Vukile. So
Kundayi, you state here 13.4% income yield.
That's right. I mean, if you look at the distributable yield, it's probably about 14.7%. And the dividend yield, which they're likely to distribute, is about 13%, which is extremely attractive at this point.
Sure, that's unbelievable. Okay.
Yeah. So that number is not a typo. It's actually what we're seeing at this point. Lastly, Vukile, retail-focused fund. It's got a combination of community centers in urban and non-urban areas. And also some retail centers in Spain. And we also quite bullish on the macro picture for Spain and maybe the undersupply in Spain of retail in some respects. We also think management of Vukile is extremely strong. And we think that this is a well-run, stable portfolio of properties. I think their vacancy in their retail sector is just around 2%. Which is extremely low. So it's a very well-run business, and we think, over time, this has proven to be a good investment for us. We're also quite positive on it as well.
Right. Sorry, let me just switch my phone to airplane mode. So I don't have any calls coming in. Sorry for the interruption. So Kundayi, let's just talk about retail. So based on what you see, and also those management team of those listed property companies feedback, are you seeing the retail sector getting back to pre-COVID, or we're not there yet, but still on the way to recovery?
You can go to the next slide and I'll talk about this, but we are on the road to recovery, and in some respects, if we look at some of the smaller community centers, some of those centers are actually ahead of pre-COVID levels. So a lot of the companies use 2019 as their base to look at their performance pre-COVID, and some of those companies are performing ahead of that, or some of those assets are performing ahead of that. So what we're seeing in the retail space is that the community centers have generally been outperforming the larger shopping malls, where there's a lot of fashion and entertainment and all of that in theaters and the big shopping centers. The community centers have got a lot of necessity-based tenants. So you typically will go to the pharmacy, whether it's a strong market or not, or you will go to your Pick n Pay and Spa, kind of irrespective, but you may not go and do the entertainment and the kind of fashion shopping in those periods. We've seen also increasing demand from what we would call mid-market retailers, the likes of Studio 88, Batu Shoes, Refinery, Fashion Fusion. These are some of those retailers that are maybe a tier in terms of size below the TFGs and Truett's and all of these guys, but we are seeing these guys expand quite rapidly. What's also very interesting is that the big names like Mr. Price or TFG, a lot of those retailers have started to refocus back home and invest less offshore, and have started to refocus on investing, expanding their stores in South Africa, which is great. So generally speaking, I would like to say the retail sector has proven to actually be quite defensive, especially the community centers. Where we are concerned is still the big, large format shopping centers. So as the petrol price continues to rise, as costs continue to affect people, they generally have less discretionary income to spend on leisure. And that is obviously going to affect the big retail centers at this point.
So the likes of Central City, Fourways Mall, and what's that? Mall of Africa. These are the malls you are more negative about their prospects.
You could say in general, I would say Fourways Mall, Central City would be more cautious. I would like to caveat that Mall of Africa, because of that area continually densifying, is a bit of an exception, because as more people are coming into the space, into Waterfall, there's just more people spending. So the numbers, the trading densities, which is the sales per square meter for that mall, continue to surprise us on the upside. And that has been doing quite well. But in general, I think the examples you have are great. The big format shopping centers would suffer a little bit more in the current environment than the necessity-based retail.
Okay. Kundayi, because now we're almost 2:00, and I just want to respect your time, also respect the viewers' time. So I'm sure we can carry on talking for another 2 hours, because I really enjoy having these discussions with you. But I think that let's look at some of the clients or investor questions. So I'm just going to go into these questions, and so maybe you can help us to understand what's the rationale to invest with Sesfikile. So the first question that I put up here from an investor is that I can buy these listed property companies through my share account. Why invest with Sesfikile?
It's a good question, and we as asset managers must always justify why we even exist, right? So, I think the important thing is really to say that if you do have the skill set to pick stocks, and it's your
Mm,
business, your day-to-day business of picking stocks and managing your portfolio, maybe you
mm,
really have a good chance by picking the companies through your share account yourself.
yeah.
But if you want to give it to as someone who's spending all their time, all their
Mm,
resources managing
yeah.
client portfolios to pick stocks, then you should go with an asset manager.
Mm,
Why Sesfikile in particular? We say that we're one of the most experienced in the sector. We've got a strong track record in listed
mm,
property. We're specialized, and that's all we focus on.
yeah.
And because also it's being managed by a team who are also owners in the underlying company and invest in the asset class, we've got strong alignment between us and our clients to make sure
Mm,
that we deliver that outperformance.
yeah.
But having said that, if you do have the skill set, you must look at the sector and make your own call in this regard. And really,
Mm,
I think that's the view we take.
yeah. No, I think that's from my view as a financial advisor. I think that it's really about the skill and the time. If you haven't got the if an investor hasn't got the skill and the time to do the analysis, follow up with what's happening with each company, and then taking all these different factors into account, and don't have time to manage to track. Then I think it's rather go with a specialist portfolio manager, a fund manager like yourself, than trying to do it yourself half-heartedly, because you could have bought like one of the companies you mentioned in the previous slide. That's great at the moment, but maybe the management team changed, maybe something happened, and then all of a sudden the share price fell substantially. And if you are not keeping track of things, then by the time you look at it, then you wonder why you are losing money. So I
Right.
think that yeah, so they are DIY type of investors. Yes, certainly, by all means, you do it yourself. But I think for many investors or clients out there, certainly investing with a good fund manager, especially in a specialist sector like a listed property, I think it will be to the benefit of clients. Then the second one, I want to just put it up here. That's a good one. So like Kundayi, that even I also have some properties that my wife and I we bought, buy to let, and I think that a lot of the retail investors, that's kind of a passion, like there's courses, a workshop out there teaching people how to go about buying property, buy to let, and so you can receive a rental income. You build your own property portfolio, and then that can be your retirement nest egg. So the question from the investor is that why invest in a property fund instead of buy to let, buy a house, buy a flat, and then rent it out?
It's a good question, Kevin, and admittedly, I haven't always listened to my own advice. So I do have a few apartments as well as a buy-to-let investors. But having said that, I think, and I'll use my experience quite honestly, and I think it's the experience of many buy-to-let investors. Is that my day-to-day work is looking after clients' money, investing
Yeah,
in listed property and
yeah,
not looking after the apartments where there's a tenant. The
mm,
issue that I think many investors have is the management headache of managing a property
yeah,
or a few properties on a to let basis.
yeah,
So, should they be load shedding at the building?
yeah,
The tenant is likely to message you to say what's going on.
mm,
Should there be some issue with damp? Should there be
yeah,
management issues? And the very common special levy from the body corporate that you never budgeted for.
yeah,
Those things all happen in the cycle of owning apartments for rent. And what you find is that over time, and then also another part is that the financial reporting of your performance for tax purposes and all of that stuff. So you find that the headache of managing apartments to let is pretty sizable. Plus, you do not necessarily get the diversification benefit
Sure.
unless you've got a massive portfolio across, the different provinces and also the different cities or maybe different countries. So what you find is that on the income level, the yield, the rental yield that you get tends to disappoint you on the buy-to-let space. You also have tenant churn typically every 2 years. There could be a period where the tenant vacates and you spend a bit of time trying to find the new tenant. There's the maintenance that you can't always budget for, that your return ends up being a little bit disappointing on as a buy-to-let investors. And also you get the administrative headache. In the listed property space, you're starting off with an attractive dividend yield of income. You do not need to go talk to any plumbers or any locksmiths or people of that sort as an investor in the listed property sector. And you immediately get a massive amount of diversification immediately. So, I feel for some of those investors who were only exposed to maybe certain assets in the KZN, and maybe some parts of Joburg that were damaged, in that those investors could not necessarily diversify away from some of these things that happen from time to time. So listed property sector takes away the management headache. It's professionally run. The balance sheets are fairly conservative. And also you can diversify yourself from single asset concentration or single location issues out of investing in listed property. And I think over time it's proven to be a better investment than buy-to-let investing, which is often a little bit glamorous. Sometimes it's nice to say I've got a few apartments here and there, but the return that you actually get from it when you do an honest calculation has been both disappointing and frustrating from a management perspective.
Kundayi, when you explain the differences, it's kind of a broad. I could not stop smiling because that between my wife and I, we have a few properties, and then I don't have time to manage, so it's really my wife managing, and it's caused her so many headaches and problems, and she had to deal with contractors or tenants not paying, and when you get to certain issues, sometimes escalate to me, then I had to step in where the tenant hasn't been paying for a few months. And it was not a nice experience to try to deal with a not paying tenant. And also I recall a month or two ago, I had to go to a unit here in Four Ways to replace the toilet seat for a tenant because the contractor couldn't find the right size of toilet seats. So actually I had to take a Saturday morning out, went to Leroy Merlin and tried to find, and it was not long enough. And I had to go back, exchange for the longest one and put it in for the tenant. So that's my Saturday morning gone. I think that for me, it's a bit of a different experience. I learned something in that, but certainly I wouldn't want to do that on a kind of a daily basis. So it's, for me, I would probably call a listed property investing more like a hygienic investing, because you have the benefits of investing in property, but you don't have to deal with all the hassles of managing or the administrative issues dealing with buy-to-lets. Okay, so just sharing my experience of frustration. All right, so then the last question I have from a client is that can a company building and selling residential houses become a REIT? So I guess this is your typical like a property development company where they acquire land and they develop residential units and then they sell it. And could these companies become a REIT?
No. A good example is Bowen Properties.
Okay.
So you can list as a property company, but you won't qualify to be a REIT. And the big reason is that I think 75% of the income from a REIT has to come from rental purposes. It can't
Okay.
come from selling or profiting from building and selling at a higher price. So you can list, but you can't be a REIT.
Okay. Well,
Yeah.
thanks for that succinct answer. And finally, can you talk about the currently your and Sespikile's assessment of the listed property sector? What does it look like? You if an investor like myself, looking at listed property, looking at the stock market, South Africa offshore, and look at the bonds, South African government bond also currently providing very attractive interest rate of 9%, 10%, etc.
Yeah.
So how does the listed property sector at the moment compare to other investable asset classes?
I mean, good question. In high level, I would say that the sector is actually quite attractive at this point, and there's a couple of reasons for that. So I think on a valuation basis, the sector is currently, as I said, trading at a distributable, not a distributable, but distribution yield or dividend yield of about 9.5. That's what we think they will distribute, and we think they can distribute more than that, so north of 10% at about 10.5. Income growth, we expect about 6% over the next 12 to 24 months, which I think is fairly attractive,
Yeah.
especially relative to other asset classes. What we've also gone through as a sector is a period of simplification. So, Kevin, you mentioned the times when companies would pay earnings out of unsustainable practices like trading profits. A lot of those practices have actually gone away,
Okay.
and we're seeing rentals coming out of sustainable income. So it's actually much more comfortable and easier to make a forecast on. Importantly, as well, the listed property sector's balance sheets are 77% hedged against rising interest rates, and the loan to value on the sector is about 38%. What's also interesting is that the sector is trading at about a 29% discount to NAV, to net asset value. So
Mm,
I think the sector is fairly cheap at this point,
mm,
relative to history and also relative to other asset classes. In terms
okay.
of how we are seeing the different sectors, as we said, the retail sector, which is about 60% of the total exposure, is
Mm,
actually quite stable, although we are
okay.
still concerned about the large format malls. The
Mm,
warehouse industrial sector is looking pretty good, low
mm,
vacancies, high demand driven by modernization of supply chain and e-commerce. And the
mm,
office sector is in a tough space where
mm,
vacancies are about 17%, so they're quite
mm,
high,
yeah.
but there's very little new supply. And we think
Mm,
that slowly but surely people are returning to the office, which could be decent for the sector. We're not saying it's improving
mm,
quickly. We just
mm,
think that it's stabilized in terms of staying kind of in a difficult space, but not getting much worse. So
mm,
generally, from our perspective,
yeah.
we are seeing a total return estimate of about 18 to 20% on a 12-month view from the South African listed property sector. And
Okay.
as you go into kind of 3, 5 year, we think about 15% per annum is
Mm.
doable.
Well, that's still very attractive given the current market condition. So yeah, so no, I think that certainly that for every investor they should consider having listed properties as part of their overall portfolio, and it's part of benefiting from this maybe a different asset class, and
Yeah.
also that the different return profile, income profile coming from that. And Kundayi, thanks very much for your time. I really enjoyed the discussion. I also passionate about property, and yeah, I think certainly I would like to invite you back some other time to talk about global property or some like like other things relating to listed property. But I think that the viewers have certainly got a lot of insights about the local and also offshore
property space. Yeah.
To thank you for.
Thank you, Kevin.